And coming up is the panel number 2. But before we move ahead, we all know that credit assessment is no longer confined to only balance sheet, credit scores, or probably historical records. Today, intelligence is becoming more productive, decisions are becoming more real time, and risk management is evolving from reaction to anticipation. Well, as digital footprints increase and expand, and customer expectation accelerate, AI and fintech innovations redefining on how financial institutions evaluate trust, identify risk, unlock new opportunities. At the same time, from alternative data and behavioral analytics to machine-driven underwriting, lenders can now have a sharper, faster, more inclusive decisions, while extending credit to under-resourced while strengthening something more important and making this portfolio more resilient proof. Well, let's welcome our distinguished guests today. They shall be talking about some of the most phenomenal topic. At the same time, we all know that the question here is no longer, can we assess risk? In fact, the question will be, can we predict it before it emerges? Talking on this and highlighting some of the most technological aspect is our distinguished panel. The topic of the second panel is credit risk, how AI and fintech are reshaping the banking. May I now call upon our esteemed panelists on the stage. First, welcoming Mr. Viraj Baragade, Chief Credit Officer, SBM Bank. Can we have a huge round of applause and welcome him on stage, please? Joining the panel is Satyendra Sharma, Chief Risk Officer, CSB Bank. Can we have a huge round of applause and welcome him as well? I'll request all of you to sit accordingly to the screens. Next, joining this dynamic panel is Ramanuj Sharma, GM and Deputy Chief Risk Officer, Bank of Baroda. Can we have a huge round of applause and welcome Mr. Sharma on stage, please? May I now request and call upon Anup Kumar Mohta, Head Credit Monitoring and Strategy, Commercial Banking, Kotak Mahindra Bank. Huge round of applause for him as well. Joining in this panel is Priya Shah, Head of Banking, Bureau.id. Can we have a huge round of applause and welcome him? Moderating this absolutely phenomenal panel is Damodharan Chambhat, CRO, Federal Bank. Can we have a huge round of applause and welcome him on the stage, please? I think when we start anything, and absolutely zeal has to be there, because I think this is going to be one of the most anticipating and a very captivating session. Can we have a huge round of applause and welcome all the leaders on this stage? Thank you for your significant presence. Thank you. Over to you, sir.
So, good afternoon, everyone. Today, credit risk management is at a fascinating inflection point. Hitherto, we were more relying on structured data, expert judgment models, hybrid and statistical scorecards, which are basically based on linear regression. From that, we are stepping into a journey wherein AI is driving credit risk by its own models. It will bring in a lot of benefits to banks as well as customers. Banks will be benefited a lot by improving their efficiency, their TAT, reducing their cost, superior selection of customers. For customers who were hitherto not even being considered for as good for giving credit, will get opportunity as banks start using these models. So it's a very great journey that the banking industry and the financial industry in India has embarked upon. So let us directly go to the topic. Before we delve into the deep things, shall I ask an opening question to our esteemed panelists? Our Deputy Chief Risk Officer, Ramanuj Sharma ji from Bank of Baroda. Sir, how are you expecting AI to drive credit risk management going forward? What all are the benefits that will accrue to banks on account of movement to the digital age, data-driven decision-making as far as credit underwriting is concerned?
Thank you, Mr. Damodaran, for this question. And I want to thank Synnex for arranging this wonderful program. Before I come to the question, let me give you one anecdote. Actually, AI is the recent buzzword, but when we want to compare with same synonym, when I joined banking industry in mid-90s, you must have remembered that computerization of banking just started. And when I joined, then around 6 months to 1 year, computer was there. Nobody wants to touch it. Nobody wants to open it. But you see the journey of banking or any segment or sector is starting that point of time and now. Now computers are the necessity. Same way, AI is the another span which right now is starting. Right now everybody is worried, concerned that what will happen to various sectors, segments if AI comes. So let me tell you that AI is a kind of next generation computers only. They are going to give comfort, they are going to give guidance, they are going to provide you the raw material on which we can take the decisions. Now, let me come to the question directly. As credit underwriting is the backbone of financing, right now it's happening through manual process where we are collecting data, we are taking financials from the customer, we are taking basically backward, looking backward and then taking decisions. What AI can do? AI can seamlessly, very easily collate those data points which are right now we are collecting manually. And this data-driven decision will be more informed decision, will be providing some futuristic guidance also. And it's not only one point decision. Right now, we are taking one decision at a time. But if we can use AI, it will be life cycle decision. Means pre-sanction, then underwriting, and then post-sanction monitoring also. Right now, we are judging the patterns of the customer manually. But AI can very well guide us, provide us the insight or various sources which are available but manually very difficult to collate and take the decision. So by AI, underwriting will be strong, monitoring will be strong, and risk-based pricing also can be utilized. Further, portfolio monitoring, let us say, right now Gulf War is going on, or maybe some kind of tariff war was going on. So manually can we take a decision that whether we want to take exposure on one industry or another industry? Very difficult. Or it will be individualistic decision. But through AI, we can maneuver and take such kind of futuristic decisions in our credit underwriting. So I hope, Damodaranji, I could able to answer.
Yeah, thank you, sir, for your valuable insights. Now, shall I ask Sri Anup Kumar Mehta, Head of Credit Monitoring and Strategy, Commercial Banking, Kotak Mahindra Bank. Sir, we are talking about transition to AI, but whether we can replace human from the underwriting chain. Right now, we are talking about human in the loop. So, where should we, is it a human in the loop, just a transition phase from this traditional scorecard-based underwriting to a fully AI-driven model, or is it going to be there for long? What is your intake on that? Where do we draw the line between AI and HI, artificial intelligence versus human intervention? Can you throw some light on that?
Yeah, thanks for asking. Am I audible? Okay, so thanks for first of all having me here. I think it's a very relevant question and very debatable question. And we do, see this kind of questions coming everywhere in every discussion, that whether AI will replace human or not. I think the discussion is not about AI versus, human. In fact, I would say that, both are complement to each other. So it is not whether AI will replace human or not. I think both has to coexist. Now, why do we say this is basically, for a standardized products, where scale is required, where there is a lot of data, you need to work on the efficiency. And there, the AI comes into the picture. So once you have the standardized products, you have a lot of data which needs to be analyzed, efficiencies has to bring in. I think there AI plays a major role. However, in complex cases, like when you do, corporate lending, or let's say you are, reviewing the account which is under stress, I think there AI might help you with some kind of data, but it's ultimately human judgment which needs to be involved. So I would say that when you want a scalability, I think there you need AI. But when you want to actually use your judgment, I think, it would require, that kind of human intelligence. So I would say that it is not basically AI versus human, but it is basically AI with human. So I would say that it is not artificial intelligence, it's an augmented intelligence, which we all need to use. We can see the photo on the backdrop, and that's exactly, what differentiates. So if you see, we have the historical monuments in Mumbai, and we do have Worli Sea Link and, basically the tall buildings and all. I think that explains the entire, AI versus the human debate. You can't destroy this also, because this is very historical and you need this. So this is our kind of the human. Can I destroy this and make these tall buildings? The answer is no, because you need this, right? Now, can I actually build all those kind of monuments and, replace this? The answer is again no, because you need scale, right? India is growing. We need scale. We need a lot of data, and that is already there, right? So you need a scale. The bridges like this will actually, be sufficient for you to take that kind of scale. So there actually, the AI would help. So this side is basically the human, and this side is basically the AI. I think both would coexist and make our Mumbai very beautiful. So I think in the similar manner, the credit also would coexist along with the AI and the human thing. And as far as the monitoring is concerned, since I handle this division, so I would say that credit risk is not complete without the monitoring. So credit is, when you take the decision, basically, it's a point-in-time decision, right? But the real test actually starts when you actually disburse the money. And monitoring is a continuous process, right? So ultimately, how you are going to recover money. So AI not AI, but basically, if you talk about the credit risk, I would say that I can decide whether I want to lend to that kind of customer or not, basis the credit assessment and all. But whether that customer will actually repay me that money or not, that monitoring will decide. Yeah, and there is a lot of AI usage what we are doing in the credit monitoring space as well. We have built a lot of models where we can actually analyze the behavioral pattern of the customer basis a lot of data. So data is not a problem now. The issue is basically how to analyze those, right? And we have a lot of data where we can actually analyze the pattern of the customer basis, the check bounces or basis the churn. So you can actually analyze those kind of things, fit it into your monitoring platform, bring some kind of external elements also like any negative news alert or those kind of things, and bring some kind of risk grading. But again, the major issue is that explainability. So you'll have to explain, and you are accountable also. So AI will help you in taking the decisions, but ultimately you'll have to explain it to the customer, not only to the regulator, right? That why you have rejected the loan. So if you have rejected the loan, obviously, it has to be explained. And if you can't, AI can't actually automate the explainability part, right? There has to be human touch, which will be explaining not only to the customer but to the regulators. So we would need, both actually. And as far as the question regarding, whether AI will ultimately replace humans, I think both would coexist, and that's not only for the short term but for the long term as well, right? So that's how I would see. I hope I have answered the questions.
Yeah, thank you, particularly for that beautiful, very suitable anecdote that you have given. Thank you very much. AI is having users in all the parts of the credit life cycle. Now let us just look at what regulatory expectations are. Regulator actually has come out with a free AI framework for adoption by financial institutions. It very much relies on, or it emphasizes very strongly on the explainability part. So as far as regulatory perspective is concerned, why they are strongly emphasizing on aspects like explainability of the AI made credit risk models and the governance around such models. My question is to Mr. Viraj Baragade, CCO, SBM Bank.
Okay, so first of all, see, in banking, every credit decision carries some consequences. And these consequences are not only for the individual borrowers, but also for the institutions. Secondly, if you see, regulator has been stressing or emphasizing increasingly on the lenders' explainability part, on adverse outcomes that we have about any of the applicants. Third, even if you see from a board committee members, board risk committees or board audit committees, they want models which can be validated as well as which can be stress tested. So from all these three aspects, if you see from a customer perspective, from governance perspective, and from regulatory perspective, any black box model, AI model, which will produce an outcome, a score, but it cannot explain why, it exposes us not only regulatory wise, but also opens a governance gap. Now, how can we bridge that gap? I believe there are various options within AI also which have been developed. So there are SHAP values. There are then decision trees which can be overlaid on complex model. And these not only explain the key factors which are which are contributing to a particular score or decision, but it also gives it in a very simple language, which can be in turn explained or placed in front of any of the stakeholders. So that way, you not only adopt AI, but also adopt it in a fashion that it can be easily explained to anyone.
Thank you for bringing the regulatory perspective of explainability. Now my next question is to Mr. Satyendra Sharma, CRO, CSB Bank. Now what we have heard about the regulatory perspective, how are banks going to implement it? Particularly from the point of view that we have seen in practice that, say, models which are interpretable may have, if you see the performance of such models, vis-a-vis the complete black box kind of model, there are some issues that are seen, at least maybe in the beginning phase, maybe it may get addressed going forward. But how are you managing these regulations? Regulation is non-negotiable. We have to ensure interpretability. Finally, it is whoever has provided the model, it is model of the bank only. We are responsible for the model governance and model validation on an ongoing basis. So how are banks actually implementing these regulations, implementing AI, duly taking care of the regulatory expectations, and at the same time managing the performance versus black box kind of issue? Can you please give your inputs on that?
Yeah, thank you, Mr. Damodaran. I think you also mentioned about this regulatory framework, free AI, that framework for regulatory responsible and responsible enablement of artificial intelligence. So this framework comprehensively covers about the regulatory expectations. Regulator has certainly certain concerns regarding this uses of AI. So they have sort of spelled out in the form of 7 sutras, 6 pillars, and 27 recommendations, so that the overall trust in the system remains intact. So among the major concerns of the regulator is the topmost sutra is trust on innovation. So trust element is paramount. So how the trust will come? So unless you use a type of models which are explainable, or more than explainable, the one who is using or deploying it, they should understand the uses of that. So first you have to understand how the model is behaving, whether the outcomes are as per the expected envisaged outcome, or is it deviating from there. But I'm talking about here the model risk. So whether that element is taken care of. So trust will come only when you have models which are whose outcomes are understandable. You know how they are built. For that, there has to be strong governance framework, AI system governance framework, which includes, of course, data management also. So data has to be fully representative. It should be complete. It should be recent, and it should not be biased. So when these type of elements are taken care of building up the model, it will be sort of giving a fair result. And of course, these models, risk models which are used for decision making, have to be subjected to regular validation. There has to be regular oversight of that one. And apart from that, it should be the process of this entire development of model, step-by-step process, using the data, step-by-step process into developing those models, coming out with the final outcome. That has to be properly documented. So documentation is again the key feature for that one, to handle this understandability as well as the explainability. Otherwise, it will be very difficult to sort of because AI keep on learning on its own basis the recent addition of the data and developments. So to keep a check on that, it has to be properly documented, regularly monitored, regularly validated, as well as audited also. So once these elements are taken care, we can say that the model are properly understood by the entity who has deployed it, and they will be in a better position to explain it to the regulator also. So that's how probably this explainability, which is the major concern in users of AI, particularly in credit risk, I think can be addressed. That's my view.
And just to add to what Satyendra has said, so basically, AI-driven credit decisioning, I think there's no risk with that. Obviously, I mean, with the human judgment and all. But the organization would suffer when they stop, questioning those kind of credit decisioning. I think that's where, the banks will have to continuously question the, output or the data or the model from where the decisions are coming. It has to be recalibrated again and again so that, your model remains relevant. Even if it is accurate, let's say 90%, 95%, it's not going to achieve the purpose, because if we are sitting with a 5% error rate, imagine this is 5% NPA. Now, I don't think that any bank can afford even 5 to 6% kind of NPA, right? So we are dealing with the public money, right? We are answerable to the regulator. So ultimately, the error rate has to be 100% or nothing, right? error rate can't be even 2%, 3%, because that will actually result into NPA, and a lot of efforts will go into recovery, and finally nobody knows whether we'll be able to recover the money or not. So I think that's where, the data validation and the calibration and explainability to regulator, and why regulator is so fussed about AI-driven decision making. I think that's the entire episode which, RBI is closely watching.
Thank you for the beautiful insights. Thanks to both of you.
Yeah, I just want to add only one point here. The accuracy which you was talking about and explainability. I think explainability is having more weight than the accuracy. Why? Because if you are not able to explain your model, then your whole exercise is gone. Whatever decision you are taking is not credit worthy to have the ground not only in front of regulator, but at the same time in front of your management, or particularly in front of your customers. Because when you are taking decision yes or no, and you don't have ground to basically tell that why we have taken this decision, that's why explainability is the very, very important. If you are using any tool, AI tool, then it must be there. Yeah, thank you.
Thank you for the beautiful input. Actually, in fact, we know there are regulations around your, you have to explain if you reject a loan, you have to explain the reason to the customer. If you use a black box, can banks really go and tell that, you see, my engine has rejected you? That is totally impossible, is it not? So explainability is very, very important. Thanks for the inputs for all the three. Now, let us just come to fintechs. Fintechs are using all this technology, I think, sorry for stating that like that, much better than banks. Fintechs actually concentrate, they use technology to give customer experience. They rely more on customer experience. What banks should learn from fintechs as far as this adoption of AI is concerned? Ms. Trisha, can you just give your inputs?
Sure. Thank you so much for the question. I think it's extremely relevant given the ecosystem that exists today, where banks have to coexist with fintechs, and very often we derive great benefits out of the coexistence of these organizations. So I think about a decade ago, when India started seeing the fintech boom, what specifically was happening was that there was an efficiency that was pumped into the credit ecosystem because of the way in which fintechs were operating. They had innovative products which they were pushing out, and they were targeting tier 1 segments with sleeker digital experiences. However, what we've also observed in the last few years has been a change. There has been a shift in the focus from specifically not just improving the efficiency of the credit ecosystem, but also expansion of it. So under the regulator's guidance, I think a lot of fintechs have now also focused on not just retargeting the tier 1 segments, but also opening new segments, whether they are MSMEs or even the unbanked segments, which are your rural population or students, or specifically focusing on NTC and how do you service them. However, one strategic takeaway, like you mentioned, that traditional banks could rely on is that I think the biggest learning we had, that was focusing on customer experience, has become very critical today. So the average consumer today of financial services products actually is far more open to discovery than they used to be about a decade or two ago. Today, an average customer for any financial product has at least 4 to 5 products that they go through first before making a decision. So, and banks, because they operate with the inherent trust of the community, and because they are seen as the custodians of our entire economy, are best positioned and well suited to actually service the growing demand. So that is what my takeaway would be.
Yeah, thank you. Thank you very much for the valuable insights. Actually, as people working on the financial space, I think mostly we are bankers among the audience. We have to learn a lot from how fintechs do things. They have taken customer experience to the next level. So in one sense, actually, customers also will be much demanding because they have understood that this kind of experience can be provided. If by fintechs, why not banks? That will be the question. So fintechs have not just been another player in the total credit ecosystem, but they are now driving the customer experience and the customer expectations as far as banks are concerned. So we bankers will have to learn a lot from fintechs how to provide that experience, duly leveraging the data and technology. Now, my question is to Viraj. You see, we have talked about different use of AI in different parts of credit life cycle. According to you, what part of credit life cycle or what phase of credit life cycle has been more benefited on account of implementation of AI, or where you expect more benefits to accrue going forward? Is it customer selection, underwriting, monitoring, as Anupji pointed out, or even collections? Collection is one important aspect where AI can be used very efficiently. So which part of that will have more benefits according to you?
See, as of now, when I see, because I've been handling the underwriting piece for a long time, I'm seeing underwriting has a major impact till now. Okay, we have seen, transition from a static credit bureau scorecards to now real-time data flow, cash flow analysis of the borrowers, very heavy data processing, EWS monitoring, those kind of things we have seen in a underwriting space. And because of which we are able to get more clients. Because of that, more financial inclusion is happening actually. So I feel credit underwriting is the area which has actually benefited a lot. Though it is more from a retail side. On a corporate side, it is more of data processing which is happening, which is helping the credit analyst or the decision makers to take a final decision. So they have a holistic perspective of a client better than what they used to have because of the large data chunk that is happening. So underwriting is the most impacted area. That is what I feel. Second is monitoring piece. For example, when we were recently doing a West Asia conflict analysis in our bank, this analysis we were able to do within 2 days period, because we were able to gather data. A lot of data was available on the market, and just basis AI, you could gather the data, process it. Final decision, obviously, there was a human element to it. We processed it. We identified the areas which are affecting our set of borrowers, and then a presentation was made to board. So this entire thing happened in 2 days. If it was supposed to be done in a traditional manner, maybe we could have taken 15 days of time or something.
Yeah, I just want to add on the same point that underwriting is the basically foundation of any decision making, correct? So through AI, as large number of data points which manually we have been collecting and then taking decisions. Now this is very easy to collate whether income tax return or GST data or maybe background of the customer also, right? So underwriting is surely will be giving good support. But as he said, in our bank also, with regard to this West Asia crisis, we are also able to collate the data and with data points, and then where the effect going to be high, low, and medium. So this we could able to do in 1 or 2 days, and then continuously updation what is happening, what is the new news, or maybe war-like situation also. So we have been monitoring continuously and consistently that how much my portfolio is going to affect it. What are the number of customer, what is the amount we may be in trouble going forward. So this has happened because of the availability of data points and then tools which we are using in our underwriting process or monitoring process. And I fully agree that banking or banking sector or maybe public sector banks are just now taking baby steps in comparison to NBFCs because they are in niche area. But when it comes to public sector banks, we have to see many, we can say, dimensions. Then only we can adopt and take it forward. So that's the point. And I'm sure that not only underwriting, but monitoring and going forward, when you have to take any futuristic decision, that is also futuristic outlook that AI-driven tools can be provided so that you can take a well-informed decision as far as credit decision is concerned. Thank you.
Yeah, and just to add to what Viraj and Sir has said, so basically as, credit underwriting, so obviously, I mean, all these three sections are benefiting, there is no doubt about it. Credit underwriting, as Viraj also said, that it has benefited a lot. Definitely, there is a visible impact. But as far as the credit monitoring is concerned, we have got the strategic impact. Okay, now why do I say this is basically, all these data points like, let's say, GST. So we do GST analysis of the entire client, and it's on a real-time basis. We can analyze the purchases, sales, top suppliers, top buyers of the customers on a real-time basis. So that helps us to monitor the entire portfolio on a real-time basis. That's one. We do take stock statement, and with the help of the AI, we can actually consolidate all the stock statement together to find out, whether sales is in line with the debtors or not, whether purchases are in line with the stock or not, and whether there are overstatement of the debtors by the client or the overstatement by the, on the stock side. So there are a lot many early warning signals which are getting generated just basis the, APIs and the AIs, because it is not something new that the stock statement has been started by the bank. This practice is going on for a long, long time, right? Every banker is aware that customer has to submit the monthly stock statement. But the beauty about the AI is that now we have the, aggregated data where we can actually generate the triggers and flash it on a regular basis and factor it in our analysis whether to exit this account or, keep it under monitoring or not. We have bank statement analysis, so we can, analyze the statement of all the banks, analyze the cash flow pattern of that bank, of that customer, and analyze, where the money is actually going. So with the help of that, we can actually do the fraud detection also. So I think monitoring also has got lot many benefits in terms of, analyzing the entire gamut which this AI has helped us to produce the data and analyze it also. And obviously, as I said earlier also, that ultimately it is human, right? So when the computer example was given, obviously, I mean, computer and human coexist even now, right? And in the same way, I think in the future also, the data, AI, along with the human would continue in all the spaces, I would say.
Thank you. Thanks all of you for the very valuable input. Actually, all parts of this credit life cycle, we have uses of AI and we will be immensely benefited. Finally, the underlying data depends what outcome that we take, what decisions that we take now heavily rely on the underlying data. So it is very important that our data should be clean. We do have a 360-degree view of customer data. It starts from sourcing and underwriting, wherein that data captured thereafter will be useful for monitoring as well. In turn, from monitoring, whatever data and whatever inputs they are having, next time when the renewal comes, for example, say where business loans are there, we need to review and renew it on a mostly ODCC and all, we need to renew on a yearly basis. So at that point of time, all these things will be coming back, plowed back as inputs for decision making again regarding credit for review. So my next question is to Satyendra ji. We have talked about different uses of AI, but what are the risks in adopting AI? Because we are again based on data. So garbage in, garbage out. The reliability, the recency, the accuracy of data, and the completeness of data will decide your model outcomes. So how are you ensuring that the models which are framed or are going to be framed using AI are reliable and relevant at all point of time?
In terms of benefits, absolutely no doubt. With AI, you are able to leverage the lot of data available and in so many sources. Currently, you have GST, you have bank statements, and you have now the government even started this AI coach also. So AI coach is also where the data can be sort of aggregated, and probably from there the models can be developed. So that's one area where the innovators can sort of build their data, and of course this can be tested and it has to be validated before put to use. So AI of course gives the advantage of utilizing the data which is available. Of course, non-personalized data, so personal data again is a different concern, which is also one of the regulatory concern. Non-personalized data is government is collating it. It is available for the innovators to sort of experiment on that one and keep on developing new systems. So government with the recent, I think, so many seminars and global events conducted, they are also promoting a lot of innovation in that field. So AI will give you definitely an edge. The performance will be certainly better. It will be more sharper. Efficiency will improve, your turnaround time will improve, your credit decisioning also will be enabled with sort of almost real-time kind of information. So there are a whole lot of benefits. Of course, I won't say the models are as good as the inputs are there. The basic data on which the models are developed, they only decide how the models will turn out to be finally. So of course, data governance is very important. Data governance is very important, should be well documented, and basis that the models, if developed and properly validated and tested, back tested, this I think will give some sort of confidence, not only to the entities, but also to the other stakeholders, including the regulators. So that's probably, I think, explains that.
And just to add to this, so data, because what is happening is that AI is driven on the data, right? And as far as the quality of data goes, obviously this is an important element. But what is more important is that the data has to be recalibrated, because you can't rely on the historical static data to take the decision on the future events. So for example, let's say the Iran war kind of situation, that may not have happened earlier, right? In your historical, maybe 10 years, 15 years down the line data. So it has to be recalibrated. If you don't recalibrate it on a regular basis, obviously the data and the decision basis, those kind of data will not be relevant to the current situation, right? So you'll have to recalibrate again and again to make it more useful so that it can sustain in the long term. Otherwise, it will collapse.
Thank you. Thank you for the beautiful inputs. Now my next question is to Trisha. Actually, banks are, when it comes to AI and adoption of technology in this big scale, now banks are more relying on third-party vendors. I'm asking Devil the question. Sorry for that. So, what all are the risks that banks should take care on relying the third-party vendors for adoption of technology and AI? And whether, what is your take on whether vendor-driven AI or in-house development of the capabilities which would be beneficial, and how banks will address the risk related to third-party vendors providing AI services?
So I'd like to take a slightly different approach on this. Instead of addressing the risks related to banks adopting vendor-led technology, I'd like to think of what the best outcome would look like. So we've been discussing the entire credit life cycle so far, and of course AI has tremendous impact on the underwriting and monitoring, but one area which I've personally seen gain a lot of benefit out of the adoption of AI has also been collections. So multi-language voice agents have been improving efficiency of how today's collections processes are structured, and the way in which today collections happens has actually been transformed with a lot of the leading banks in the country. But here there has been a best outcome has only been able to be achieved by these organizations by leveraging both their vendors' technology but also bringing in their in-house expertise. So I know slightly diplomatic answer, but I would say that it is only possible to achieve the best outcome because banks today know their customers better than anyone else. They understand the demographic better than anyone else and their legacy systems more than anyone else. So while vendors will continue to bring in forward-looking industry-first expertise, experience as well as technology, it's important for both to collaborate to achieve the best outcome.
Thank you. Hats off to you for the very bold statement on that. Now let us let us have one-liner, quick kind of response, rapid fire. My question is to our Satyendra ji. A in credit risk, is it a evolution or revolution?
Difficult question. So it has to be sort of both. Of course, it's an evolution in a way that it is progressing. We like other panel members mentioned about, we have come from long way from manual days to adapting to computerization, now getting into further sophistication, and finally getting into the AI. And of course, with AI, a lot of disruption also comes. So a lot of disruption comes, we can't deny that, and for that only sort of bothering the regulators, not just domestically as well as globally. So it is sort of both, I would say. So we have to be mindful of the risk involved in AI getting into the next level, and we have to have proper guardrails built in to take care of that. So risk mitigation is very important while adopting any innovative technology.
Thank you. My next question is to Mr. Ramanuj Sharma. Which segment of credit portfolio will be most benefited due to AI? Is it retail or is it corporate? Is it micro, small business, commercial banking?
I think it will be benefiting mostly large masses in a small segment, retail and MSME. And as far as quality is concerned, certainly it will be in corporate segment also. But mostly because of this TET and all, which right now is means credit decisions are taking, that can be automatized through AI. And consistency is very important. Right now, what is happening, because of various data points and all, manually we are collating and taking decisions. So that may be here and there, but as far as when it comes through AI tools and using this technology, then this decision will be having consistency. Means if all the same, then decision will be same, kind of thing. So mostly AI will be giving lots of comfort to the masses. That's my take on.
Thank you.
Thank you.
My next question is to Viraj ji. Credit decision, say 80% AI and 20% HI, that is human intervention. Is it realistic or is it risky proposition?
I think it is realistic. In fact, AI can go up to 100% also in case of retail, mass segment. And in case of corporate side, it has to be somewhere around 30-40% HI needs to be there, because it is more of judgmental calls, historical performance that we have seen with the client, the hold that we have on the client, the churning that we have on corporate clients. So there are a lot of judgmental elements to it. So I feel there you can take a component of 30-40% HI, but retail, it can go up to 100%.
Yeah, exactly. You see, the kind of microfinance loans which serve as financial inclusion, can banks with their current cost structure, of course, even through BCs, can banks afford to go without fully digital? I am not sure. Currently, we may be serving some segment, but financial inclusion in its real sense, we will have to adopt 100% digital. Whereas that may not be advisable in case of high value credit, say corporate credit or commercial banking kind of credit. That's it. Yeah. So Anup ji, my question is to you. Fintech, is it a strategic necessity or a competition threat?
I would say that it's a strategic fit, basically. It's not a competition because, see, I mean, I think both will have to coexist, okay? Because as far as data needs are concerned, we need bulk of the data coming from various sources. I think there, fintechs are playing a greater role. In fact, we are also using fintechs to, get those kind of data for our analysis, monitoring purpose. So I think fintech has a great role to play here. Uh, in terms of the competition, obviously, I mean, in some of the segments, definitely we will have competition, so nobody can deny it. As far as the retail loan goes, obviously, I mean, they might be superior to what, the banks are doing right now. But obviously, I think both has to coexist, and in India, I mean, it's a land of opportunity, right? So, I mean, nothing will die, right? We have seen those kind of things. Even newspaper also exists right now, and the online mobile reading of the news also exists, right? So we will have to coexist. I would say that. Yeah.
Thank you. Yes, a right kind of partnership where both, not both actually, where the three stakeholders win. That would be a right kind of proposition when it comes to partnerships of banks. Now, my one just last question, it is to you, Trisha Madam. You see, benefits for banks. Where do you foresee which will be what will be the highest, higher benefits for the bank on adoption of AI, whether it be reduction in TAT in credit decisions or in improving operational efficiency or improving the overall credit quality as we have talked about?
I would say all of the above. I think right now the way we've increased the adoption of AI, we're definitely seeing improvement in efficiency as well as in reduction of TAT. I think all of the panelists have highlighted the same. But with the kind of augmentation it's bringing in even how our credit decisioning and how our models perform and how they move from more static rule-based engines to more dynamic machine learning-based models as well. I think overall credit quality should improve as well. But I do agree with what the panelists have also mentioned, that human intervention will depend on on the kind of credit segment we are speaking of as well. So there will be some amount of subjective depth we will have to bring to each of these decisions. But I think it's all forward-looking from here.
Thank you.
Yeah, I just want to add one point that this customer experience is very important. So can we provide the best customer experience through AI or not? I think manually, just you were mentioning that financial inclusion at that mass level, how much tedious for anybody to take a loan, not only TAT, but how much thorough, whatever he's going through is very, very difficult for that person who wants 5 lakh or 10 lakh or 15, 25 lakhs rupees loan. But can that be automatized through AI? Can he get instantly? So that is very important. So as he was mentioning that corporate credit can be okay, that there 30 to 40% or maybe 50% you can use human versus AI. But at that, for masses, for customer experience, I'm sure that AI can make the change. AI can provide the platform and the level where this can be, we can have that level of, we can live comfort, and then customer experience can go at the next level. That's my point. Thank you.
Thank you. Thank you for the inputs. Now we can open the forum to the audience. You can ask, please ask relevant questions to the panelists.
We're a little crucial on time and standing in between the lunch, so if there are no questions, I think a brilliant session, I will say. Can we have a huge round of applause, everyone? Wow. So if credit is a lifeblood of economic growth, I think intelligence is more becoming of a valuable currency as AI and fintech coming together to transform the entire lending landscape. The future definitely belongs to the institution who can balance with innovation and, as we mentioned, inclusiveness and resilience. Kudos to all the leaders out here. I think they have shared their very key perspective from their experience. Can we have a huge round of applause for all of them? So as I already mentioned, the leaders are just not the one who are inclusive, but also who are driving the growth in fintech and banking industry. Thank you so much. And I'll request Mr. Ajit D'Souza Business Development Manager, greylabs.ai, to please join in to felicitate our fabulous panel out here. I may request Mr. Viraj to please join us on the center stage. Viraj Baragade, Chief Credit Officer, SBM Bank. Sir, I request you to please join us on the center stage. Thank you so much. Can we have a huge round of applause, everyone? Once again, a brilliant insights from you, sir. May I now call upon Satyendra Sharma, Chief Risk Officer, CSB Bank. Thank you, sir, for your great inputs. We have a lot of key takeaway from this session. May I now call upon Ramanuj Sharma, GM and Deputy Chief Risk Officer, Bank of Baroda. Thank you, sir, for joining us. Pleasure having you and listening to your perspective as well. May I call upon Anup Kumar Mohta, Head Credit Monitoring and Strategic Commercial Banking, Kotak Mahindra Bank. Thank you, sir, for joining in. Thank you for your insights. May I now call upon Priya Shah, Head of Banking, Bureau.id. Thank you once again for joining. It was fabulous conversation between the leaders. And thank you, our moderator, for moderating this fabulous panel and making sure we are navigating toward the right path. Damodaran Chambat, CRO, Federal Bank. Thank you so much for fabulous and very insightful questions. I'll request everyone to please for a group picture. Can we have Mr. Ajit on the stage for a group picture, please? I'll request everyone with the certificates to join us for a group picture. Well, yes, ladies and gentlemen, I think today's discussion definitely reminds us that the future of credit is just not for the faster decisions alone, but smarter decisions. So let's have a huge round of applause for the entire panel, for the roadmap that they have set ahead for all of us.